Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the S&P 500, comparing the bear markets. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. We, of course, do have several tiers that you can choose from to get access to various types of content. Now, what we want to do in this video is to just sort of follow along with the S&P 500 bear market. Because we've been following this for a long time, might as well continue to follow it until it's decisively over. Now, this chart shows you every single bear market in the S&P 500 going back to the Great Depression. Now, of course, it's very convoluted to look at it this way, so we will quickly hide all of them and pull up the current one that we are currently living through. Now, what's interesting is we can go through and compare this bear market individually to prior bear markets, and we are going to start off by doing exactly that. The first thing I want to look at is to compare this to the financial crisis from 2007, 2009. Now, there of course was the bear market from 2020, but it was really short-lived, and then the Fed just printed our way out of it, and arguably led into the crisis that we are living through today with high inflation and the Fed having to raise interest rates much higher than they have in a long time. But the cycle goes on, right? If you look at this bear market compared to the financial crisis, it has followed it somewhat closely. Now, that's not to say that you're going to have to see a major meltdown like the one we saw back in 2008, but we have to admit that it is always a possibility. I mean, this bear market over here continued to put in lower highs and lower lows, and then eventually the floor fell out. One positive thing usually with the floor falling out is that you kind of get further in, right, to the bear market, so to speak. If you look at the 2000 to 2002 bear market, it actually lasted a good bit longer. And one of the reasons, arguably, is just because it remained a fairly structural bear market just for a long time. There wasn't really a major capitulation in the sense of what we saw during the financial crisis, where we just dropped really, really quickly and got to the end of the bear market much quicker. The dot-com crash was more similar to just a structural bear market through and through, and it lasted approximately over 900 days. For context, the current bear market is about just over, let's see, what is it at right now? About 330 days or so. The current bear market is maybe 331 days or so. Again, the one from the dot-com crash lasted over 900 days. We're not saying that has to play out the same way, but it does give you some context into what is theoretically possible. I mean, if 2022 has taught people anything, it should be that bear markets can last a while. And I mean, at the beginning of 2022, when we started talking about this bear market and how it easily could last for a while, especially given high inflation and the Federal Reserve's response, it's really no surprise that 2022 will just simply be remembered as a bear market. And of course, this bear market could easily well extend into 2023. If you do compare this to a few other bear markets, we can go look at periods of high inflation. You had the early 1980s. You can see that bear market, while it did last a good bit longer from where the current one is, it didn't actually go too much lower. So when you think about bear markets, there's two components to it, right? There's the price component and the time component. Some bear markets, also like the 1946 to 1949 bear market, some of them don't really go that deep, right? So if you compare this one to that bear market, they don't always necessarily go that deep, but what you will see is that they can often last a while, right? They can last a couple of years, up to 2 or 3 years, just depending on how bad it is. And so that is something I think it's worthwhile to consider. There's also the bear market that we experienced from 73 to 74. On this bear market, basically from these levels, more or less just went sideways for, another 200 days, more or less, before finally getting the final capitulation into that final bottom. One thing to consider, though, I know it can be somewhat depressing to look at this kind of stuff, and you can already start to feel like the apathy setting in, I think, for a lot of different people. It was interesting, though, right now. I mean, the S&P is actually sort of back at a somewhat major resistance level. But to a large extent, especially in some risk assets, I think apathy is starting to set in, and it can set in if the price just sort of goes sideways for a while and trends down. It's when it gets that, really apathetic is usually when you get really great value in long, with some of these long-term investments. But one of the things that you should look at, not only just comparing the bear market, is actually take it out to the next peak, right? So it always puts into perspective the bear market phase, right? Like during the bear market, it feels like it's never going to end. But then typically, once you get out of the bear market, it just sort of seems like, such a brief moment in time where we spend so much time worrying about everything. And then eventually we sort of come out of it, right? This is coming out of the 73 to 74 bear market. Coming out of the financial crisis to the next peak, that's what it looks like. Kind of crazy, right? Like, I mean, if you just look at it to the bottom, it looks quite scary. If you take it out to the next peak, it's kind of like, oh, this was a great opportunity, right? I mean, that's the point, right? This was a great opportunity. Now, living through it at the time, of course, it probably wasn't that obvious to everyone, but it was in fact a great opportunity. And you can go through and look at a lot of them, right? This is the one from 73 to 74. I maybe already showed that one. This is the one from 80 to 82, right? So just comparing it to the bottom, that's what it looks like. Going out to the next peak, that's what it looks like. Getting through the bear market is hard, right? It's difficult. A lot of people capitulate all the way down, and eventually, the last person will capitulate, and then it's just, we go back up for a while, and then they FOMO back in and lead the rally on. And then we sort of rinse and repeat the same cycle over and over and over. And then we can also compare this one to, say, the bear market from 1937 to 1942, 1946 to 1949, 56 to 57, going through the bear market and then to the next peak, 61 to 62, bear market into the next peak. This one looks more optimistic, right? This one paints a more optimistic picture. 66 to the next peak, the 68 to 70 bear market to the next, after the bear market into the next peak, and so on and so forth, right? You get the idea. The general point here is that bear markets in the S&P 500, they vary in length. I mean, sometimes they last about a year, sometimes they can last 3 years. But betting against the U.S. economy over, say, like 10 to 20 years typically doesn't work out that well, right? The U.S. economy has proven itself to be fairly resilient over longer periods of time, and the people that just sort of stick it through ultimately do well over the macro scale. Now, zooming into where we are today, I guess, is somewhat relevant, right? And we've been following this for a while, so I thought today might be a good day to make a video. Now, if you view this on a log scale, right? If you view this on a log scale, you can kind of see that we are at this downtrend line. So we hit it in January, and in March, and in August, and now again in December. We've put in new lows in January, and in February, in May, in June, and in October. So far, this remains a fairly structural bear market. Now, there's no evidence clearly yet that we're going to break out of this and go to new highs. And if we do come back down, I think probably the first area to look for would be around that 3,400 level, right? If it goes back down to 3,400, that would more or less represent a pullback of approximately 30% or so, which is also equivalent to the pre-pandemic high, right? About a 30% drawdown from the all-time high. And if it bottoms there, if that's ultimately the bottom, assuming the bottom's already in, right? But if that's ultimately the bottom, then you could argue that it's a soft landing, right? So like if this comes down in bottoms sometime in the first quarter or something of 2023 at around 3,400, then I think you could argue that that is a soft landing. If on the other hand, we capitulate much lower and go say to 3,000 or sub 3,000, that would be defined by a hard landing in my book. And the reason I say that is because, if you look at prior bear markets with the S&P 500, a lot of people don't like to look at these bear markets, but this drawdown here was in fact about 50%. And then this drawdown over here was also just north of 55% or so. So far, the S&P has really only fallen about, 28% or so. If it were to fall 50%, that gets you to 2,400, right? If it falls 40%, it gets you to around 2,900, and a 30% drop gets you just below that $3,400 level, which again is the pre-pandemic high. So, I still do think it makes sense to watch this relatively closely. I wouldn't necessarily get super excited about immediate new all-time highs, even if this breaks, right? I mean, it could just break and be a false breakout and then come back down. And then, of course, the other way to look at it, that's just probably a preferred way, is to not look at it on a log scale and look at it on a linear scale. And if you look at it on a linear scale, you might even be able to say it already broke above it a little bit, right? We already sort of broke slightly above this level. But again, I mean, these are major resistance levels by the S&P 500, and until proven otherwise, I assuming it's just a structural bear market, so far has worked out pretty well, right? Now, eventually that thesis will be wrong, but so far, I mean, it's worked out relatively well. And I mean, even back over here in August, there were so many people calling for a melt up to new all-time highs. That didn't happen. It's gonna happen literally every single counter trend rally along the way, and this sort of keeps people FOMOing in, right? I mean, they FOMO in at these sort of tops, and then they capitulate at the bottoms. This is not the person you want to be, right? This is not the person you want to be. So, I look at this. I look at the overall structure here. If I can go back. I look at sort of the overall structure here of this bear market, and more or less just assume that it's likely going to continue playing out for a while. I think the main issues that we have right now are the Treasury yield curves, right? You look at the spread on it, the 3-month and the 10-year. I mean, this is a fairly steep inversion, and it's lasting, several days, several weeks. So I think there's some merit to it. Normally when this happens, we end up getting a recession. The reason why that's important is because bear markets that include a recession tend to last a lot longer than bear markets that don't include a recession. The yield spreads, right? The yield curve and the spread on the yield curve of the 3-month and the 10-year and the 2-year and the 10-year both suggest a recession is on the way. I don't know exactly when it's going to occur. I mean, if I had to guess, I'd say 2023, but they might not declare it until the third quarter or something. If you look over here, back in 2006, there was an inversion, but the recession didn't start till 2007, right? So it inverted in summer of 2006, and then we had the recession starting in November of 2007. If you look back in, during the .com crash, we inverted in the summer of 2000, and the recession started in early 2001. And then here we've inverted. If we zoom in here, you can see that we really started to invert in October. So, I mean, the recession, by the way, however they're going to define it, with unemployment starting to go higher and maybe the yield curve uninverting, we could still be 6 months away from that. Okay? Now, if the recession is included in this bear market, then there would still be some evidence to suggest that the structural bear market could continue to go on for a while, just like what happened in the .com crash or the financial crisis, right? I mean, these bear markets lasted a long time, and both of them also had a recession in them, right? So important things to consider. Important things to consider as we continue to navigate the Equityverse. So, I really am curious as to what the S&P is going to do here if we just simply get another rejection. Note that we are right above the 200-day SMA as well. Last time we got to the 200-day, we got rejected off of it at the downtrend line. Now we're slightly above it. We also went slightly above it back in March, and we got rejected from the downtrend line again. So, and then the last thing I want to look at just briefly is the 200 week, because, the 200 week is where we bounced off of recently, right? We sort of bounced off right here, the 200 week. And if it were to fall, if you go back and look at where the S&P has previously bounced, you can see there have been some fairly significant bounces at the 200-week SMA. So I don't think you should just completely discount it as irrelevant, right? But also remember that we did not have high inflation during 2016 and 2018. And we were not really looking at an inverted yield curve either. So just because we bounced off of it over here doesn't mean that this bounce has to be sustained. It will really much be dependent on a lot of macro factors that haven't really yet been fully fleshed out. And if you go back to say the financial crisis, you can see we bounced off the 200 week, and when we bounced off of it, right, when we bounced off the 200 week, if we just take it from the 200 week, we bounced up about 11%. If we take it to the wick below it, it was about a 15% bounce. And then if you go back over here and look at the wick just below the 15 or the 200 week, we're currently sitting at about 16 to 17% above it. So I mean, as we get into the end of the year, I mean, I know people are talking about like a Santa rally and everything, and that might be possible. I think the biggest risk to traditional markets right now is what happens next quarter and in Q2 of 2023 when we start to get earnings for a lot of companies that are finally starting to feel the effects of all the rate hikes that occurred in 2022. So inflation was the 2022 narrative. I think the 2023 narrative is going to be earnings. And how badly did the Fed go, or how high did the Fed go, and how badly did it hurt the U.S. economy? I'm not saying they shouldn't do it. I've been clear all year that I think it's what they have to do. They have to get inflation back down, and raising rates is a good way to at least try to do that. But still think it's worthwhile to consider that inflation's the narrative of 2022. Good chance it starts to come down in 2023, but that doesn't mean the bear market, we can't still be somewhat bearish. In 2023, you're probably going to see earnings be affected by a lot of the interest rate hikes. Remember, it takes like 3 to 4 quarters for these interest rate hikes to be fully felt. And if you go look at when they started raising interest rates, right? I mean, you can see they didn't really start until early 2022. So once we get into early 2023, or even right now, you could argue some of these companies are finally starting to feel the effects. Therefore, that could be the narrative of 2023. But anyways, I hope you guys enjoy the content. Make sure you subscribe if you're not. Again, check out the Into the Cryptoverse Premium. We have that link down in the description below. We have several tiers as well. Make sure you guys check that out, and I will see you guys next time. Bye.